Imagine watching months of careful, disciplined trading vanish in 3 minutes. Your screen freezes, a giant red candle slices straight through your stop loss, and your entire account balance evaporates. When this happens, human nature kicks in. A standard high-impact news day usually creates a fast dip that quickly finds a price floor, giving buyers a chance to jump in and ride the correction. But treating a structural crash like a normal dip is a lethal mistake. The oversold RSI readings and long-term support levels on your screen mean absolutely nothing right now. Risk philosopher Nassim Taleb calls these events black swans. They are massive, completely unpredictable outliers that shatter the normal operating boundaries of the financial system. This chart shows the March 2020 COVID liquidity crunch. Here, the established rules of the market broke down instantly. Look at this massive vertical drop. The price didn't slide to the next support level. It teleported, leaving a massive liquidity gap. Trying to squeeze a profit out of a free fall guarantees you will lose your capital. To stay in the game, your priority must shift from chasing profit to ensuring survival. To understand why price floors vanish, we have to look at the global financial plumbing. When a crash hits, certain currencies skyrocket while everything else collapses. Under normal conditions, large institutions run carry trades. They borrow massive amounts of low-yielding currencies to buy high-yielding, riskier assets like emerging market stocks. The Japanese yen is the primary engine for this. It's cheap to borrow, making it the perfect funding currency to bankroll global speculation. But when panic strikes, everyone rushes to the exit. To close their trades, institutions rapidly liquidate risky assets and urgently buy back the yen. This creates a brutal deleveraging spiral. The yen spikes, triggering margin calls, forcing even more buying, sending prices parabolic. The safe haven surge isn't driven by investor confidence. It is a mechanical, forced liquidation, a physical market force that will crush any retail trader trying to go against it. This mechanical reality is exactly why your standard trading indicators break down during a panic phase. A hedge fund facing a margin call doesn't care if a currency pair sits at historical support. They just need to raise cash instantly. This creates correlation convergence, where assets that usually have nothing to do with each other suddenly drop in lockstep. You will see traders dumping their safe winning assets, like gold, simply to pay for their massive bleeding losses in the stock market. While the charts are breaking down, the physical mechanics of your trading platform break down too. In a liquidity void, the price on your screen is rarely the price you actually get. Your stop loss is just a pending market order. If the market suddenly drops 50 pips with no buyers in between, your stop loss will execute at the very bottom of that drop, locking in a brutal slippage penalty. To survive this execution risk, use the VIX rule. The moment the volatility index crosses 30, automatically cut your position size by 50%. To protect against slippage, stop using market orders entirely, switching to limit orders to strictly control your entry price. The hidden mechanics of a liquidity void can easily destroy an account, even if the trader correctly predicts the market's long-term direction. The irony of a market crash is that the most profitable trades happen right after it ends, but only if you have enough capital left to participate. The temptation is to jump in on the very first sharp rally. This is the dead cat bounce trap. It lures early buyers back in, only to wipe them out as the market crashes even lower. Your first rule of recovery is patience. Wait at least 48 hours to let the initial violent cascades of margin calls finish washing through the system. Instead of guessing when the bottom is in, look for mathematical proof that the forced selling is exhausted. You are looking for volatility compression. This chart shows the average true range indicator on a 4-hour time frame. When you see those massive, towering volatility spikes finally shrink down into tight sideways movements, you know the panic is physically exhausted. Navigating a black swan is about protecting your capital, avoiding the obvious traps, and waiting for rationality to return to the charts. Make sure your risk management is ready for the next wave. Download the FXNX VIX-based position sizing calculator and trade on an institutional-grade platform built to handle extreme conditions. The link is in the description.